thinking about buying a block of land in a little area that was known as a swamp at the time, and he helped work for the developer to develop all this. He was offered the land cheaply for about $60,000, and their good friends talked him out of it. They said, that will never take off, it's just swamp, who'd ever want to live there? That little swamp was known as Noosa Waters, if you know, Canal Estate in Noosa. Those land blocks would go for between $1.5 million today. Okay, so being talked out of things by people that are uninformed can cost you a lot of money. True? So you probably all had a horror story like that. Foresight requires us to go on faith, do our research, and have the courage to act today, and time can reward us. There's no guarantee though. We say, well, if someone could guarantee it, I'd do it. If someone had guaranteed it, everyone would do it. The fact there is no guarantees is the opportunity. Okay, and what you're weighing up is every decision. To not invest is taking on a risk. True? For me not to buy that property at $17,000 cost me a lot of money. Okay? Cost me a lot of money not to do it. The risk was if I did it, there was a risk that maybe it wouldn't go up in value or not by much. True? There's a risk to everything we do. Most people think by not acting is avoiding risk. But in most cases, the ironic thing is by not acting, not investing, is taking on the highest risk there is. So it's looking at it accurately. You're weighing up one risk to the other. You can't escape risk. There's a risk to everything you do. So if you can't escape risk, what you should then do is how do you minimize it? And what we want to do, all this to becoming successful, is all about how do we maximize our returns in any investment we do by lowering the risk. Like I was talking about the other day, like if I'm riding a bike, how do I maximize my enjoyment and my speed by lowering my risk? So I'm still being defensive and conservative, but I'm maximizing my fun. It's the same philosophy to investing. So what I learned was one of my other mentors said, Jamie, you don't like shares, but I want you to really look at it in a different way. I didn't like shares. I thought, well, it's easy in property, just buy it and it goes up in value. Why would I want to try and... Shares are complicated. You can't just throw a dart at the top 100 shares in the ASX and whatever you land on buy and come back in 10, 15 years and see how they're going. If you did that 15 years ago, threw a dart at some of the top 100 companies on the ASX and come back now to see how they're going, you'd be surprised, you'd be looking, where the hell are they? A lot of them had disappeared. True? Or some of them went backwards a lot. Imagine AMP buying that 15 years ago. Would you be excited today? Would you even be excited about buying Telstra off the government? Talk about insider trading. They send people to jail if they can catch them for insider trading. I got to say that it's interesting how the Australian government offloaded some of their Telstra shares recently, or last year, whenever it was, just before they knew they were about to announce some negative news that was going to send the share price down. Is that not massive insider trading? You happen to know you're about to announce something about the potential breakup of Telstra, which is going to send the share price down, and just before that they offload to you guys a whole heap of shares. But anyhow, different rules for the government to different rules for yourself. So, what my mentor said, Jamie, property is great for you, but betcha it's taking up your cash flow in the beginning. It's negative geared, you're getting tax benefits, but it's burning your cash. I said, yeah. He said, what you want to look at is shares, is don't look at shares like most people. Most people look at shares for capital growth. He said, look at them for cash flow. He said, did you know you can do a strategy? He didn't call it share renting, because that's something I termed later, but you know you can generate cash flow from shares. I want you to treat it as a business. And as a business, imagine if you have a business that takes up 5 minutes a month, no staff, no overhead. It's an asset you can easily borrow against. Anyone can borrow for it. It's the easiest finance you'll ever get if you want to borrow for it. You can insure the business, and you can operate it from anywhere in the world 5 minutes a month, and it can throw off monthly cash flow month after month, and it's one of the lowest risk strategies you can do in the share market. There's a risk to it, but it's one of the lowest risk strategies. And I'm like, he got my attention. He's already excited by that concept. And that's how I come across share renting. Can we just put up the disclaimer quickly, because we're going to talk about shares and advice. So just quick disclaimer so everyone's clear. I am actually licensed to be able to give advice on the share market, on general derivative advice and derivatives by the ASIC. My goal, however, is not to obviously give you advice. My goal as an educator is to teach you what is and then to teach you to think and come up with your own decisions, and for you to play above the line. Above the line is what? Being accountable, responsible, taking action, and being aware of what's working and what's not. Below the line is what? Tell me. Denial, blame, excuses. Now, if you're going to become an investor and want to play the game below the line, guess what's going to happen? You're going to have some learning lessons. Okay? You're going to get hurt. You can blame all you want. You can make all the excuses you want. You can live in denial. But at the end of the day, to be successful, we have to play above the line. Okay? So if you invest, you have to say, I'm fully accountable and responsible for my actions. And my whole goal of educating people is to say, don't rely on other people. I always say, don't rely on other people for advice around money. Because most people, most industries have an agenda behind that advice. True? What you want to do is become your own expert. Then utilize the resources of other people that have knowledge that you don't to help you make a decision. Take that information, those strategies, and come back, and then you make the decision. Say, if I do this, I am responsible for the outcome. Because what a lot of people do is they get lazy and they go, oh, well, I'll do this. I'm not sure what to do, so I'll ring my broker and I'll see what he recommends. And then whatever he says, I'll do it. And that's being lazy. I've done that in the past. Every time I've done that, I've lost money. Every time I've made the decision, go, okay, what am I doing? Am I going to be responsible for this? If this happens, it can go up, can go down, sideways. When I'm prepared for that, I'll usually do well. Once I get lazy and don't want to make the decision myself and push it off to someone else, then it doesn't work for me. Who can relate to what I'm saying here? Okay? So it's just about being an adult, isn't it? We have to accept the consequences of our actions, and there is no guarantees. But what we're going to do is stack the odds heavily in our favor. That's what we're going to do. And share renting is heavily stacked in your favor. Okay? So I was looking for this for cash flow. So what I did, it was going to take me 10, 15 years. Eventually, the rents on my property would far exceed my debt and pay off the property. But by doing this, I was able to borrow against my real estate, a line of credit, put some money in the share market. That would generate me some cash flow, which I could use either to pay off the debt quicker, or what I did was use it to borrow more for more real estate. So then I had more real estate going up in value, and I had more money to put in the share market, and I could now do this cycle. And exponentially, by using both, getting bigger and bigger, faster and faster. But here's what a lot of people do. That's great. And they go, I'm going to quit my job and just focus on this. I think that is like putting a brake on. What I did is I didn't. I moved into careers that I was passionate about, and I needed a lot of variety, so I started multiple forms of income. Because my first mentor that I talked about yesterday, millionaire mentor, he had about 15 different forms of income. So I just naturally modeled that. I said, one day I want to have that many forms of income. And today I do. I don't say that to impress you, but impress upon you, because over the time, when you free up your time, you get excited, you get creative, and you want to start a new form of income. So I've started many companies, company after company, or income after income. Investment income, business income. So as a result of doing that, then by building up these many forms of income, I have more money to put over here. Making sense? So then you can exponentially grow up more. So what do? This blueprint I'm giving you is the exact same thing I do to this day. I'll go back to my blueprint and I'll continually work on this. I'll continually work on building my business incomes. I'll continually work on growing my property portfolio. And I'll continually work with the share market. Now, sometimes I'll do more on shares, other times I'll do less, depending on the market. Okay, and depending what I'm doing. Who's following what I'm saying here? Okay, so then by combining all these, so that's what we then started to do about 4 years ago, was introduce 4 or 5 years ago, start teaching our students about internet and business. Because once you had your property going, it doesn't take a lot of time. You can be share renting or doing some of the other strategies. It doesn't take up a lot of time. And you're moving out of your career. You might work back, go on contract, do the time rich type thing I was talking about, free up some of your time, and you're ready to develop other income. So a lot of people then got into the internet and building internet forms of income. And that was just additional cash flow, and they could pour that into their investments, and they just got where they want to go that much quicker. Okay? So, let's look at quickly line of credit. Jot this down. Some people think they don't have any money, but before we go into that, let's go into this. 8 steps to getting started. This is fairly basic, but it's critical once again, even if you're a sophisticated investor in the room, to come back to this and say, how do I get more money for investing? The first thing you can do to invest is, one, save some money. True? I've never met a successful investor yet that doesn't have the ability to save money. Number two is you could sell something. What I mean by that, maybe have a garage sale. Most people have spare furniture, spare car, spare boat, spare spouse, spare kids. Whatever it is you can cash in, okay? Invest it now and pay for it later, and get it back later. Number three is your tax. Most Australians are paying too much tax. Who would agree with that? Okay, I think our country is absurd on their tax rates, and it's a long-term problem. It's interesting, I was doing a business deal in Asia recently, and I'm amazed how much, obviously entrepreneurs overseas, they know how much about Australia. And they know Australia is one of the few countries in the world that will tax its citizens on its income no matter where you earn it. Well, other countries don't do that. Like if you earn income overseas, the Australian government, even though it's not income that belonging to them, they'll want their hands all over it. Did you realise that? You can have businesses overseas and they'll want their money. Because our government spends more than really it should and has for years, and they're very aggressive now in trying to get all the tax. Some of you would have saw what they did to the Myer family and TPG with the Myer float. Did anyone see what happened there? I know. Well, the ATO went and tried to freeze the Myer family. Well, they did freeze the Myer family's bank account and a private equity firm's bank accounts. They wanted $650 million in capital gains tax and penalties. Now, if you lived in Russia or China in a communist regime, you'd expect that sort of behaviour. But think about the message that it sends to the world. Here is a government department that clearly knows that foreigners do not have to pay capital gains tax in Australia. They went and tried to freeze the bank account. The only reason it was stopped is because NAB basically told the court there's only $45 left in the bank account. It's pointless freezing it. The money's gone. So the private equity firm floated Myer. They bought it many years ago. They refloated Myer. They made $1.5 billion. And the ATO tried to take $600 million of that, saying that's ours. When it's not. Okay, the rules are pretty simple. If you're a foreigner, you're investing here, you're not an Australian citizen, capital gains. But what it sent a message to the world is that here is Australian government at the same time travelling around the world spending a lot of money to convince foreigners to invest in Australia. Because Australia, the big asterisk to Australia's future is that we spend more than we earn. You realise that? We spend way more than we earn. So we need foreign investors in our country. Otherwise we go bankrupt very quickly. So they're spending money trying to convince people to invest in Australia. Then they have a government department called the ATO that's trying to invent rules and basically act like a communist regime and steal money at the same time. So it's sent a very damaging message to the rest of the world. And that sort of behaviour is what can cost Australia a lot of money. Because a lot of foreigners now are refusing to invest here unless they're guaranteed that this sort of behaviour won't go on. Who's following what I'm saying here? Okay? You can see I have a bit of an opinion about the ATO. The point is, I agree you should pay your tax, but the operative word is a fair amount of tax. So you want to do everything legal because there's no point becoming wealthy and then being sent to jail for tax evasion. That doesn't really get the outcome, does it? But it is a concern in Australia. I think we're going to lose a lot of talent because a lot of people will get fed up and just leave the country because they're not going to pay the tax rates. Number 4, the best thing about minimising your tax legally is investing. Investing is the best way to minimise your tax legally, especially with property. Number 4 is your income. So your income is you want to go to work on increasing your income because that's going to give you more money to invest in the share market, more money to invest in the property market. Number 5 is OPM. OPM stands for what? Other people's money. So in other words, if you don't have money, you can borrow it. So a quick example of that was, I'll give you an example of one of our 22-year-old 21st century member a few years back. What he did was decide to borrow $40,000. He didn't have the money at the time, so he borrowed, took out a personal loan. He had a job, clean credit rating, so he was able to borrow $40,000. He wanted to do some share renting, so he's going to, rather than spend $40,000 like a lot of 22-year-olds, what would they spend $40,000 on? Cars. So a lot of people say, investing is risky. Don't do that. Go and buy a car instead. Okay, that's the psychology of the average Aussie. Okay, not smart. Avoid risk. So he decided, no, I'm going to do my homework, I'm going to choose the shares, I'm going to play above the line, I'm going to be responsible, accountable, I'm not going to blame anyone. If I buy these shares, I'm taking on a risk, which you are. If you buy any shares, you're taking on a risk. So $40,000. He had also learned that you can margin loan in the share market. So he margin loaned that up, because margin loan, generally can margin loan up to double what you put in, actually more, but generally double is the maximum. So he's able to get a margin loan. He had his personal loan, that gave him $80,000. He went and bought shares with it. So he borrowed, but he borrowed to invest into an asset, as opposed to borrowing to invest in a car, which is not an asset. That gave him $80,000. He was able to make many months of the year from that, around about $4,000 in premiums from share renting. Out of that, he had to pay his interest bill. Okay, he'd pay an interest on this, he'd pay that over time. But he's already saving some money, so the money he was saving, normally, he used that to pay the loan repayments on this. Now, a margin loan, you have to pay the interest repayments monthly on a margin loan, yes or no? Those you don't know, you don't have to. It's not like a house loan where you have to pay money every month. A margin loan is a capitalised loan. So jot that down, capitalised loan. What that means is that the interest is just added to the loan, and when the shares are sold, you pay it then. You don't have to have the cash flow to pay it every month. And is margin loans easy form of finance compared to, say, a property loan, yes or no? Generally, yes, even though, in the sense the credit crisis has become a little bit tougher than what it used to be. It used to be anyone could get a margin loan. Now it is banks a little bit more, because of all the issues that happen with some of the margin lenders, Tricom, etc., they've tightened it up a little bit. How do you get a margin loan? I hear some people like, Jamie said just about anyone can get a margin loan, and they speak to 21st Century Finance and they say, no, you can't get a margin loan. The reason 21st Century Finance can't get you a margin loan, because you don't get margin loans from a finance broker, okay? You get your margin loans from where? Stockbroker. Stockbroker or the bank, and the stockbrokers will do the applications via the banks, etc. So your margin loan, you don't see 21st Century Finance for that. They'll help you with property loans and line of credits against your house, but they can't help you with margin loans. See 21st Century Broking, they can take care of that. Okay? So that's an example. I'm not saying go out and borrow money. I'm not saying that. I'm saying that's up to you what you do. I'm saying what others have done and what is possible. But if you're going to borrow money, you want to invest it into an appreciating asset. Number 6 is equity. The most common way, if you have a house, is you've got some equity in it. So let's say you have a $500,000 house. A lot of people think, oh, I don't have any equity, I don't have any money to invest. And let's say you owe the bank $300,000. How much equity do you have in this property? You have $200,000 equity in that property. Make sense? So generally you can get a line of credit on your property up to what percentage? Generally 80%. At one point there was up to 85%, but generally 80%. So 80% of 500,000 is what? Is 400,000. So if you owe the bank, in this case 300,000, you could increase this loan up to 400,000 in a line of credit. That would give you how much more cash you could access? That would give you from 300 to 400, that would give you an extra $100,000 of this money that's in here, locked up in the house, that you could pull out and you can do whatever you want with that. The banks, you can go on holiday if you want. Actually, you can write down when they ask you, what do you want to do with the money? You could write down anything. It doesn't matter, they'll still give it to you. Okay? They don't care, because they've got security. So that $100,000, obviously you wouldn't go on holiday with it, you go on and reinvest it. Maybe deposit another property, or maybe into the share market. That's what you can consider. Okay? And it's always handy to have a line of credit set up anyhow. Let's imagine there's a family emergency, you needed money in a hurry. You've got your line of credits already set up. At least you have access to money. Liquidity at any time. Liquidity is always important. Having access to liquid assets. Okay? Number 7 is, if you don't have any equity, then that's what your parents are for. Okay? Parents' equity. Maybe you can do a deal with them, convince them that to work with them as a partner. Maybe they'll let you access their equity, put a deposit on a property, etc. If you don't have parents that will do it, then that's where you get your grandparents. You strap them into a lounge chair, you put my DVD on, okay? You get the paperwork out and you have them sign over their equity, and away you go, okay? And number 8 is superannuation. Superannuation. So a common way, a lot of people don't realise they can change their super funds to a self-managed super fund. Warren will talk to you about that later tonight, about how you can go about doing that. Who has a self-managed super fund? Raise your hand. Okay, a few people. So that's a way that you can use your super money to do all these strategies with and invest with. Okay, and then there's also pension funds. You're becoming 60, 65 years of age. There's a lot of things you can do with pension funds, tax-free investing, etc. So you want to check all that out. Warren will talk about that stuff, and they can help you if you need a hand there. Okay, so here's what I want you to do. Quickly circle which one of these 8 steps you are currently using in your investment strategy, and maybe highlight the ones you could potentially use, and then turn to your buddy and just share with your buddy. I'll give you 60 seconds. Go for it quickly. So before we get into how to invest this money in the share market, which we're going to go into now, it's important to stick to the basics of how do you actually come up with the money. Okay. And it doesn't matter how rich you become, you would still go back and look and say, okay, how do I expand this? Can I access more equity? Can I utilise my super more? Can I go to work on my income? My tax, that's an ongoing thing. How do I minimise that consistently so I have more for investing? Or how do I use investments better to take advantage of the legal tax ways to save your money? How can I get rid of some junk? Or how do I save more consistently? Okay. What I'll do is I'll teach the next part, then I'll take some questions then. Okay. So let's look at the share market quickly. Let's assume you want to go and invest in the share market. Here's a few things that you can do with the share market. Let's imagine we have a share called XYZ. It's an example. It doesn't really exist. And let's say XYZ share was $16. And let's say we go and look at a chart for the last 12 months. This is a 12-month period. And we're seeing this share goes up and down over time. And let's say it's been getting up to around $19 something. What that tells us by getting... the first thing what we want to do is we need to know... the first step, I guess, is really needing to know when to buy a share. Okay, what price to buy a share at. Most people would sort of guess or take a tip from a taxi driver or someone, or they'll buy a share based on a hot tip or on an online forum or something. So it's usually not a good idea. So when buying a share, I would suggest the person to model is someone like a Warren Buffett. Who would agree that would be a good role model? Warren Buffett's the most successful investor in today's world, and he has a pretty simple criteria when buying shares. So he has basically 3 main criteria. The first criteria is this: he only ever buys a company that is profitable. How complex is that? How simple is it? But would that save you a lot of pain, yes or no? He only buys a company that is profitable. He's not interested. So that's his rule. Only buys a company that's profitable. It's not making money. Why would he want to own it? That's his rule. So number one, if you do that, you'll be ahead of most investors. So how do you find out this information? Well, what I do is I read the Financial Review most mornings. I read the Australian newspaper. I read the Daily Telegraph because there's sports in there. So I read a lot of newspapers, but I'm reading them to see what's going on in the market. Just by reading them, if you're following some stocks, in the Fin Review there'll be updates about the company, etc. Doesn't mean you believe everything that's in there, but there'll be updates and factual information about shares, and it just keeps you in the loop of what's going on. If you're going to be a share investor, you want to know what's going on with the economy, you want to know what's going on with particular companies. And as you're in the market longer, you'll just naturally build up a library of knowledge about particular shares. So there's a lot of shares that I've traded in and out of over the years that I know fundamentally a lot about the companies. So I know what they're up to, what's happened in the past, and that gives me greater and greater insight, so I have an advantage over, say, someone like yourself that's just coming into the market that doesn't have that knowledge. Okay, but how do I get that knowledge? By being in the market and by studying over time. It's something you just get better at. So, and I've always been one to focus on a few shares as opposed to spreading across a whole range of shares. Why? Because I can get more greater depth of knowledge on a few companies than if I have to try and study 20, 30 or 40 or 50 companies where you don't know that much about them. So only buy a company that is profitable. That's good business sense. 2, his second rule is this: He only buys a company that he understands how they make their money. Jot that down. I'm not telling you here how a billionaire become a billionaire. If it worked for him, it can work for you. He'll only buy a company that he understands how it makes its money. So, for instance, in the dot-com boom, Warren Buffett was heavily criticized. They said, he's over the hill, he's old, he's probably losing his marbles, he doesn't know what he's on about anymore, the internet's changed the world, and it's here to stay, and really he's old school. Because he refused to invest in dot-com companies. But he refused to invest for two reasons. One, were they making a profit? No, most of them weren't. Two, could he understand how they're making their money? No one else could either, okay, because they weren't. Therefore, he has hard and fast rules. So he doesn't have to like, should I, shouldn't I, maybe I should. No, his rules are black and white. Making a profit? Yes, no. No. Do I understand how they're making their money? No. So is he going to fundamentally invest in those companies long term? Of course not. And even though he saw companies that's listed at 10 cents go up to $100, $200, he wasn't going to invest in them because that's what his rules. Now, if you're a speculator, different story. So there's two forms of investing. You're an actual fundamental, you use fundamental analysis. I'm into fundamentals. You can use also technical analysis, which some of the other speakers will talk to you about. Technical analysis is looking like a chart, the past history, and looking for patterns with a share. And it's handy for shorter term trading. Where fundamentals is good for all sorts of trading, including long-term trading. Fundamentals are looking at the profit and loss of a company. What are the fundamentals of the company? If a company's making more profit, it should generally increase the share price. Not always, but should generally do that. Now, you can either be, there's two things. You can either be an investor, or you can be a speculator. Now, some people think they're investors, but what are they really? They're speculators. So a speculator would have been someone that's going to take a punt on a dot-com company before they crashed. They might have bought it at $1, and they speculate it's going to go up in value. They're speculating because fundamentally you wouldn't touch it. It might be $1, it might go to $100, but fundamentally there's no fundamental reason it should do that, and long term it's going to crash. As a speculator, you might take the risk and go, okay, I'm going to speculate and buy it at $1 and hopefully sell it at $5 or $10 or $50. You're speculating. Now, is it okay to speculate, yes or no? Jot this down. It's okay to speculate as long as you admit you're a speculator. Once again, don't be in denial. You are speculating. Therefore, you are taking on a greater risk, and as long as you know you're speculating it could all come crashing down, that's okay. Because you can still make a lot of money out of that. But as long as you're not kidding yourself, you're not BSing yourself that, oh yeah, fundamentally it's fine. Making sense? Therefore, you're a much better investor if you're doing that. So Warren Buffett didn't touch that. He was criticized, but guess who had the last laugh? He had it because they all come crashing down, except the companies that had a fundamental, solid business plan. What were some of the dot-com companies that had a fundamental, good business plan? Tell me. Google, eBay, Amazon. Making sense? They actually were making a profit, small at the time, and they... you could understand how, if you studied them, you could understand how they're making their money. Like Google only makes its money one way, pay-per-click advertising. Most of its money comes from that. Even though it was small back then, you could look at that and go, my God, if this takes off, this company has potential. Because what Google is doing is reshaping a whole industry. An industry that's ripped off people for years is being reshaped. Advertising industry. They charge for an ad whether it works or not. Okay? Now Google come along and said, no, we'll charge on performance. And that's basically what they did, and that's a massive industry, and that's why they're a huge company. So they did something different. And Google, think about how much have you paid to use Google? Nothing. Is that a successful business? It offers you a free service. Does that add value to your life? Massively. Massive value. It adds, all it is a website. But who would like to own the Google website? Okay? It's just a piece of real estate, online real estate. So it's an idea that's made the founders billions of dollars. Because, think about it, they've come up with an idea and added value to society. That's why they deserve to get incredibly rich. If you add that much value to society, you'll make the same amount of money. So, fundamentally wouldn't touch it. Kerry Packer was a little bit like that. Kerry Packer, you realise that Jamie Packer has actually had made more money than his dad while his dad was still alive. PBL was worth about $10 billion at one stage, mainly because their investments in a company called OneTel, which is really tagged into the .com telecommunications industry at the time, and also I think a company called eCorp. So most of their $10 billion value at the time was largely because of James's investments. So James thought he was the new king, and Kerry was quite grumpy about it. So the day the dot-com crash happened, even though it wiped off $500 million in the first day of Packer's wealth, Kerry apparently was as happy as Larry and come back in the office because he was predicting it would crash. Fundamentally, it made no sense. He couldn't understand how they were making their money, and it's going to come down one day. And he was happy, even though he lost $500 million that day, he was still happy because it meant him, the old school, was back in power, as opposed to the young ones that thought this was just an easy way to make easy money. So never forget the fundamentals. So Warren Buffett's done very well at that. Warren Buffett never invested in Enron either. Okay, once again, were they making a profit? Well, they claimed they were. No one really knew. How were they making their money? They're still trying to figure that out. Okay? No one knew how they're making it, so they wouldn't touch it. Coca-Cola. Does Warren Buffett like Coca-Cola? He invests in that. Why? Is it a simple business model? Do you understand how they make their money? Because you know their business. You know that you drink Coke, people make around the world, so you understand their fundamental business. So then you've got more of an idea as an investor to go, what's the future of Coca-Cola? It doesn't tell you everything, but it gives you an idea because you understand their business. You shouldn't be investing in something you don't understand, because if you don't understand how they're going to make their money, or whether they do make money, how are you going to make judgments on its future? You have no hope of doing that. So a very successful fund manager, I forget his name, it's quite famous in the US, and he says this simple thing: if you want to become an investor, just go and buy into companies that you are a client of, that you like. If you're a consumer of a company and you think it's a great company, go and buy shares in it. For instance, what's a great company? Apple, for instance. If you love Apple products and you see everyone's getting an iPhone or a Mac and all these things and you think it's great, that gives you insight knowledge, doesn't it? You go, my God, everyone loves these things. Everyone's buying them. Could that mean that Apple's share price could go up? Yes or no? Absolutely, it could mean that. So you have some insight. You're a consumer and you have some insight, and that can give you a clue. I'm going to go and buy Apple shares as an example. I love this company, but you're not making an emotional decision, remember? You can buy it if you love it, but that's an emotion. You're making a decision based on, I love these products, I know a lot of other people like these products, they seem to be creative, they seem to be reinventing and making all these sales, then there's a fair chance that's a good, solid company for the future. Making sense? So it can be as simple as that. So number 3 criteria Warren Buffett has. He will only buy businesses that are undervalued. Jot that down. He'll only buy businesses that are undervalued. So 1, that are making profit. 2, he understands how they make their money. And 3, that they are undervalued. Now, Jamie, what do you mean by undervalued? Well, let me ask you this question. Is there companies on the Australian Stock Exchange or the US or wherever that at times are undervalued? Yes or no? Many times, almost all times, there's some companies that are undervalued. So 2 things that can affect it. There's fundamentals that can affect it, or the other word is